Hey, what's up guys? My name is Andrew. Welcome back to another video. And right off the bat, you can definitely tell, new setting. Just got some new lighting equipment and a new backdrop with the sea and two boats that actually fighting, so they're not friends. But yeah, I just spent the last week moving from Austin to Dallas, and I just found out that all of my classes at UT Austin are going to be online. So I decided just to spend the last week to set up all the recording equipment, the lighting, just the camera and everything, which I'm actually recording on my phone, but just spent the whole last week doing that. So that's why I haven't uploaded a video in the last 2 weeks. But hopefully this should be the setting for the next few months up until the beginning of 2021. With that being said, let's get right into the video. Now, when it comes to beginners, there's always that one looming question: what should I invest in? And let's face it, we all have that one friend that says they like to invest, but in reality, that can mean almost anything. And so in today's video, we're going to be talking about the top 4 most common investment vehicles, which is mutual funds, index funds, ETFs, and stocks. And really understanding these 4 investment types is really a crucial piece for beginners to understand what they're going to be investing into. I'm going to be explaining the differences between each investment type and what each one is really comprised of. Now, before we get into the video, do leave a like for the YouTube algorithm, and if you're new to the channel, do me a favor and please subscribe. With that being said, let's get right into the video. Now, to really start things off, we're going to answer the age-old question: what is the difference between a mutual fund and an ETF? Mutual funds were first created in the 1920s and really became popular in the 1980s, mainly because they were comprised of many financial assets into one investment, which means it's automatically diversified. Now, in the turn of the millennia, ETFs have gained a lot of traction in the past 1 to 2 decades, which means it's a newer investment vehicle. Now, ETFs, they can definitely have the same financial assets as mutual funds. Really, the differences come down to how they're traded throughout the day. ETFs are traded via the open stock exchange, and they fluctuate and change over time based on the underlying financial assets of that ETF. Now, mutual funds, also known as open-ended funds, are investments offered by mutual fund companies such as Vanguard, Fidellty, and Blackrock. Since mutual funds can't be bought on the stock exchange, their prices only change at the end of the trading day, and the price change is based on how many mutual funds were bought or sold during that day. Now, the biggest concern that you should really know is the expense ratio between an ETF and a mutual fund. Typically, ETF expense ratios are going to be less, ranging from 0.5% to 0.7%, with the average being around 0.6%. Mutual funds, on the other hand, have about an average expense ratio of 0.73%. Now, ETFs can be easily bought and sold on the stock exchange, which means they're more liquid than mutual funds. And you can easily make trades throughout the day with very accurate prices, since the prices are tracked real time, and you can see how much it fluctuates throughout the day. So next, we'll be comparing ETFs and stocks. And stocks in general is just a term for shares invested into a company. So if someone says that they're invested into stocks, this can mean that they're invested into one company or an X amount of publicly traded companies. Stocks are traded the same way as ETFs, so they're bought and sold on the stock exchange. And on top of that, both are constantly updating, so you can get a real-time look into the prices and how much they fluctuate throughout the day. Now, the real difference is the underlying assets between an ETF and a stock. When you're buying a stock or a share of a company, you're investing into an individual company and its operations. Now, if you're a partial owner for a company, let's just say, for example, you own 20% of a company's shareholdings, then you get 20% of the company's votes. However, not all companies have shares that allow for voting power. For example, Berkshire Hathaway's Class B shares don't hold any voting power. In order to gain voting power, you would have to own a Berkshire Hathaway Class A share, which is famously known to have a very high barrier to entry due to its price. ETFs, on the other hand, are crafted with many different underlying financial assets and are split between 4 different subcategories. Diversified passive equity ETFs typically track the benchmarks of a stock market index, such as the S&P 500 or the Dow Jones. So if the S&P 500 falls about 2%, which is roughly about 64 points, then the ETF that tracks the S&P 500, such as the SPY or the VOO ETF, will fall about 2% as well. These ETFs follow the stock market, so you will make an average return of about 7% on the conservative side. The second ETF is the niche passive equity ETF. And basically this ETF is what it sounds like, and it focuses on a subset industry of the S&P 500. So if you want to invest into bigger and growth companies, then the SPY-G ETF would be a really good investment since it puts a bigger emphasis on companies that have a higher growth. Or maybe you want to refine your investment portfolio to hone into the financial sector. Then you can invest into the VFH ETF, which is comprised of financial service companies. The third ETF is an active equity ETF, and these are actively managed and constructed by financial experts rather than tracking a traditional index such as the S&P 500. Typically, these ETFs are higher risk and have a higher expense ratio since they're managed by actual people rather than just tracking an index. Now, fixed income ETFs are the fourth one. They focus more on bonds rather than stocks, and they typically have a higher expense ratio since they're actively managed. However, they do have a low turnover rate and don't bring that much in returns, but it's a very good stabilizer for market volatility. Now, if you look at the characteristics of an ETF, you can definitely see that it contains characteristics of both a mutual fund and a stock. So if a stock and a mutual fund had a kid, then it would probably be an ETF. For example, stocks are traded on the stock exchange, just like an ETF. But ETFs also have the diversity as a mutual fund. So for the last comparison, what's the difference between an index fund and a mutual fund? And this is where it gets a little bit confusing. So index funds, all index funds are mutual funds, but not all mutual funds are index funds, because index funds are a subset to mutual funds, and a mutual fund is just a broad generalization of a class of investments that has a certain structure to it. Mutual funds are divided into 3 subcategories: debt funds, equity funds, and money market funds. And index funds fall within the equity fund, along with many other investment types. So index funds were first introduced in 1975 by Jack Bogle, who designed a fund that would track the common stock market index, such as the Russell 2000, S&P 500, Dow Jones, and the NASDAQ. This was revolutionary and became a benefit for so many investors. And the main reason why was you didn't have to invest into something that was actively managed. Instead, you could invest into something that was passively tracked, such as the S&P 500, because it's an index and there's not really anyone controlling the index fund. This means expense ratios were significantly less on index funds. For example, the first S&P 500 index fund, VFAX, has an expense ratio of 0.04%. And the average expense ratio for an index fund is 0.15%. And the main goal Jack Bogle had in mind was to allow investors to keep up with the stock market rather than beating it. Typically, among investments, index funds are traded the least since they're more of a long-term investment, which means you will get some tax benefits to it as well. And to clarify some of the confusion, here's a diagram that I created to help depict the investment types discussed in this video. Now, to answer the basic question that every beginner has, what should I invest into? The reality is, I think you should invest into all three types of investments, and here's my reason why. Now, if you're a long-term investor who wants to replicate the stock market returns, then the index fund is undoubtedly the best choice to go with. The reason why is there's a very minimal expense ratio since it's passively managed, and you get a ton of tax benefits for holding it long-term. Typically, on average, you should expect a 7 to 9% annual return based on the historical data, and you won't be able to outperform the stock market since the purpose of an index fund is to track the stock market. Now, if you really want to refine and fine-tune your investment portfolio to put a bigger emphasis into a certain industry, then an ETF would be a good choice. On top of that, you get automatic diversification and real-time updates throughout the trading day. Last of all, if you want to invest into a certain company, then buying traditional stocks is what I would recommend. Typically, this is more risky, and you would have to go through the financial sheets for a good investment. But if you pick the right stocks, then you could potentially outperform the stock market. And that sums up the video, and I'm going to be leaving all the links down in the description below as per usual. With that being said, if you guys enjoyed the video, leave a like and comment down below. And if you didn't, leave a dislike. And if you want to see more content like this, please subscribe. If you want 2 free stocks on Webull, link down in the description below. Sign up, create an account, and deposit $100 and get 2 free stocks valued up to $1,400 and hook 'em.